Welcome back to this week's Golden Rule Radio. This is Rob. We've got Tori and Miles today. Now, I want to start off with a question. I understand the technicals that you talked about last week and why gold is in a downward move, technically. But what I want to understand for our listeners is let's try to put it all together fundamentally. Why are we seeing what we're seeing and what's happening around the world?
That's a question all three of us are being asked all day long from clients or people even prospectively looking at acquiring gold. So I think that is the question of the week. And you could go back a few weeks and flip that and say, why is gold running? Why is it taking off and why has it gone up 11%? So we addressed some of that. And to me, the turnaround can be explained similarly. I mean, if this was a geopolitical emphasized run, it would make sense that without a further escalation in the Middle East, you should naturally see the metals stabilize and come back down. We have to remember that we started in the low 1800s, as Miles pointed out last week in the charts. We've got some support levels that we should expect to come down to. You have to expect things to come down. I know I'm getting into the charts here again, Rob, much to your chagrin, but you have to expect us to get down towards the moving average because, again, we talk about when you separate from that moving average, you know, that it will snap back like a rubber band towards it. Mm-hmm. So that's not a surprise. But to me, there's two primary reasons, and that is real rates. Gold doesn't do necessarily as well when there is an improvement in the real rate of return. So the higher that interest rates go and the more yield you can get in, say, bonds, the less desirable gold appears at that point.
To a degree, but if you look at the interest rates on the Treasury market, they've been actually dropping as well.
That's correct. And it actually, to me, is why it was surprising that gold, again, aside from the geopolitics, I don't know that it would have, but gold staying so strong. Silver, even more surprisingly, staying so strong. And given some time now, and it's not like there's a pacification in the Middle East, but there's not an escalation. So without further escalation, we're starting to see gold settle in now with where things are economically, financially, fiscally, monetarily, right? All the other things that impact it.
Right. But when you look at it from that standpoint, we're still putting more treasuries in the world market than the world is ready to absorb. And we can't afford to raise interest rates against ourselves because of what we've been talking about for months now. So nothing has changed. It's only gotten worse fiscally.
Well, that's why gold is at 1960 and not at 1660.
Yeah.
Arguably, it could be much, much lower because, as you point out, in a rising interest rate environment, if things really are healthy, Miles pointing out the equities markets hanging in there. They're not setting new highs, but we're certainly not seeing the 2022 type of a weakness.
No, we're not at all. And I think that's a very important point. Yeah, it's a little softer from where we were, but this is a fairly shallow correction.
Yeah.
The fourth time in 5 years that gold's breached 2,000.
Yeah. Well, and the dollar is staying strong. I mean, it's relatively strong. We're stuck between 105.5 and 106.5.
Yep.
So again, it's all very pleasing to me. The bigger question is, why isn't gold dropping further? And it really has been that risk appetite. What is the appetite in the markets for risk assets versus risk off assets? Gold was redefined with Basel III as a zero risk asset, tier one.
Tier one.
So the more that people, whether it's individual investors, the retailers, or it's hedge funds or pension funds or banks, and working your way up to central banks, the more that they're seeking physical gold as a result of safety due to perceived risk in the market, the more the gold price is going to climb. But you're not really seeing that. David McElvaney brought up a point on Tuesday, and that is this massive reduction in ETF ounces. Mm-hmm. That's telling us that the bigger money, the institutional money, is not chasing gold right now because they don't see the risk. And that's more surprising to me, is there are red flags left and right in the economy, the debt, the spending, and we'll see if the government shuts down. You want to add risk to the markets? Let's see what happens again next week.
Well, that's a great point. I mean, if there ever was a time when the red flags waving and the red lights are blinking and the fire has begun, now would be that time. And yet I somehow think the guys on Wall Street are pushing their agenda so they can get their bonuses wrapped up before Christmas.
Well, and I think it's also what makes gold go considerably higher,
Yeah.
because the pullback is not as shallow as one would argue that it should or could be. If we bounce off 1900, Miles, where are we going? I mean, I'm going to pull you in here chart-wise, but the bulls, the consensus is that we're going back to 2100. That's just the average consensus.
Yeah, everybody
the gold
expects
bulls expect an exceeding of the 2300 mark in first half of 24. That's where I personally lean, because we're not getting a deep retracement.
No.
Gold is strong here, and I'll take the discount. So let's throw the chart guy under the bus and see if he has anything to add on fundamentals.
No, I think you guys are doing great. I'm just going to stay over here. Appreciate it. I loved sitting listening to this for the last few minutes because my wheels were turning and I wasn't rambling, which is good for me. Rob, why do people do what they do?
Because they want to.
Well, how many times have I heard you say that over the last 20 years?
Almost every day.
Almost every single day. Why isn't gold going up right now? Because it doesn't want to. It's just like you guys were talking about. It's not the central focus right now. It was 2 weeks ago. It's not today. And market-wise, we've gotten really fickle. Like, talk about short-sighted. It's amazing to me. We used to talk in years and decades. Now we barely talk in microseconds if you work on Wall Street. Just on the show yesterday, David brought up the Battle of Waterloo. The fact that the Rothschilds were able to short the market a couple hours before everyone else because they had the faster carrier pigeons and horses.
Yeah.
Like the speed at which information travels used to be days and weeks. Now it's microseconds. So I'm looking at something like this and I'm thinking, okay, well, what's leading what? Getting back to the charts. And what do people do in a crisis? And I was talking to a client this morning, and from my perspective, there are 3 things you do in a crisis. First thing you do is you get rid of the bad. Then you do what I call circling the wagons. This is where you're selling off bad asset. You're just getting liquid. You're getting liquid and you're getting possession of things. And then finally, what you do is if things continue bad and you were lucky enough to get out at the beginning, not the end, you go looking for some type of alternative safe asset to invest in. If the stock market's crashing and interest rates are going up, you look at things like bonds, treasury bills, gold. Kind of sounds similar to what's going on right now. Vice versa. You know, if the bond market is falling and things are calmed down, well, you go look at things like the stock market, like you should have been doing in 2012, 2011, when the stock market had already bottomed. So we have this like 3-step process. You know, you cut out the cancer, you take stock of what you have, you collect it, bring it into yourself, and then you go out and you start looking for alternatives. So what are we seeing right now? Well, we're seeing the bad getting cut out. And I think the equities market is the bad, and I think the equities market is leading the precious metals on the flip side. And the reason is gold was going up, the equities were declining. Sounds real familiar to a couple years ago. Well, here over the last week, as the equities market has rebounded, what has happened? We've had almost perfectly clean 618 retracement in the Dow. Gold isn't halfway there yet. We're not even to the 382, let alone the 50%, let alone the 618. So I think the Dow is leading out the precious metals markets right now. I think people are getting liquid. I think people are very concerned. They're not quite ready to polish the shotgun yet, but they're definitely remembering like where the key to the cabinet is, so to speak.
Well, speaking of gold and the 382, where is that mark? I know the 50 is like 1911. Where's the 382? 1950?
Yeah, I'll double check when I put charts together for the show, but I rough sketched it. It's more like 1935,
Okay.
1911 on the 50, and then the 618's down at like 1888.
So it's fairly tight.
Yeah, we're pretty tight here.
These are tight.
Yeah, we're talking a $200 rise, so most of your fib levels are all going to be kind of packed right in there. And then you stack in like the 200-day moving average is parked right in the middle there as well.
Where is the 200-day?
200-day moving average right now is at 1940.
Thanks.
So
Okay.
the 200-day
I
at
did not have it.
1940, the 50 days at 1947. So, you know,
We're
why
right
wouldn't
there.
we?
Yeah, we're all right there.
We're right there.
We've got another $20 to go, you know, 15, 20 bucks, and that's to be expected too for me, like I said earlier on. And we may overshoot it a little bit. I think we will. Those averages, you know, move slowly because you cross up and down and all around them.
So Dave goes into a long, very dense discussion on the bond market yesterday on this week's McElvaney Weekly Commentary, because Dave knows a lot more about that market than I do. But you're looking at the bond market, which, what were we joking about a couple weeks ago, Rob? Like, if the first bond auction didn't work, just make the second one bigger.
Yeah, just add more to it.
Just add more to it.
What could go wrong?
Yeah, exactly. If nobody's eating the pasta salad, next church potluck, bring 2 pasta salads.
Right.
Yeah.
Well, that's today. The 10 and the 30 are being auctioned off today, and we'll see tomorrow how that all played out.
Yeah.
Yeah.
So the general public who isn't buying 10s and 30s, they're not auctioning to you and me.
No.
So the general public in the secondary market, which is going into short-term treasury bill money markets and 1 year and 3 year maybe, that's getting out of the equities market, coming into the liquidity. That's that 3-step process I was just talking about.
Which, by the way, if people are interested in going into treasuries instead of leaving money languishing at a bank, they can go direct to the treasury and buy their own treasuries, or they can have our wealth management team put them in treasuries. It's like half a point to do the management of their treasury portfolio. I just thought I'd throw that out there.
Yeah, it's a good point, because I think a lot of people are running away from the banks. You know, we just got our third quarter bank ratings, too, from the Weiss research.
They're dropping.
Everybody's down again.
It's incredible. I mean, the systemic, uncertainties are certainly in that market. Just like the economy. I mean, unemployment went up 0.5%, and yet you're seeing the equities markets still climb and the dollar unchanged. I mean, we're in a recession. It's not really playing out that way. And I would urge the listener and our clients too, don't get sucked into the short term. Like, okay, going back to your question as to why isn't gold doing what we wanted, or why doesn't gold want to, the way that Miles would ask. And to me, it's really, don't get sucked into that short term. There's all these little underlying currents, but ours is a very slow, patient, methodical asset. It's a diversification in the portfolio that we have to focus on the long term. And all of those pictures are painting a very grim long-term picture.
Very.
And those short-term ones are merely opportunities. The more we see these opportunities to dip and add to ounces, the better it is for the portfolio in the long term. We're not trading. We're not leveraging. If we were short-term trading, that's different. But follow the money, follow gold really from west to east. Not a whole lot of interest in the west. China's on record pace, right?
A lot of interest in the east,
Yeah, why? There's another why question. Why is that, right? So we all believe that the dollar's going to turn down significantly at some point in the future. We believe that the equities are going to turn down. We believe that bond yields necessarily have to come back down, even if that's not short-term. All of those things will lead to a climb in the gold price and an adjustment accordingly to all the other things that are going on.
Well, and you mentioned you think the dollar's going to turn down. We're seeing some slippage in the dollar index right now. Since we put that top in at the beginning of October, we failed to put in another higher high, and we've put in 3 consecutive lower lows. So, like I've said in the past, are we just pulling the drawstring back for the next interest rate hike and the next bump up in the DXY? Or are we going to see a decline in the dollar? I mean, we've slipped from 107 back down to 105, but it's done it in a really shallow stair-step pattern. The dollar is losing at least international dollar index favor.
Well, I mean, we're losing demand from abroad. They're not stepping up at the Treasury window. We are adding to the auction. People are trying to figure out what's ahead. If they're going to balance their way into, like you say, Miles, getting rid of the bad, pulling everything in close by, I can see a strong consensus for a combination of treasuries and gold. And it is like buying an airplane. People can do it on their own. I mean, you can go out and buy gold. There's a number of online account websites that you can buy gold from. You can go direct to the Treasury and do it on your own, but it's like buying an airplane. It's kind of helpful to have somebody sitting next to you that's flown these skies for decades like we have. So if people are like we are, they are concerned. They're asking, why is this happening? Why are we not seeing what we thought we would see? They need to figure out who their co-pilot is.
No, that's a really, really good point. And we have to be able to talk to clients and keep them grounded.
Yes.
To play on that too.
Yeah, because we're
we're
not trying to scare the willies out of people, but we are concerned.
Yeah, and focus on the long term. And again, look for value, look for opportunity. And in the short term, Miles, does the dollar turn down? I don't know. In the long term, we believe it will. In the short term, it may not. It would surprise me if it doesn't, because you have 12 reparations bills to pass in Washington in a week. And all of them involve incredible spending, and that's funding the government. Then you have this looming government shutdown if they don't get that done because of divisiveness and a lack of cooperation. And so that would certainly impact the dollar. But David was talking about the fact, too, that gold is at an all-time high in all these other currencies around the world. So I would even argue that gold is doing what it's supposed to be doing. It's just that the U.S. dollar as a reserve currency is its own separate it's on an island. Mm-hmm. And we're measuring the ounce of gold in U.S. dollars. We're not measuring it in pounds and euros and yen, where it's just skyrocketing, hitting all-time highs, right? Mm-hmm. So gold is doing its job worldwide, and we've got this Fed tightening cycle that is still intact as well. When the Fed pivots and they do two things, they reduce interest rates on the Fed lending rate, and or they start to quantitative ease again, that's when we're going to really see it run to that 2,300 and above. And that's not a speculative investment. That's just repricing itself with where it should be relative to the rest of the market and the sheer number of dollars that have been printed, Rob, which is your number one metric. Yeah. I mean, money supply is
everything.
The guru in.
Yeah.
Yeah, and I think what we're also going to see, regardless of what the Fed ends up doing, because let's say if there's that third option where they actually do keep raising interest rates and just accept the fact that deflation's coming, whether we like it or not, the nitrous in the gas tank starts to lose effect. Like, we're going to see that take place as well. The value of the U.S. dollar on an international basis, every time they raise the interest rates an extra percent, it's not going to have a percent worth of return. That's going to be diminishing returns over time, and diminishing returns turns exponential pretty quickly. So that's where I start getting concerned where, okay, is the dollar going to go down if the Fed has to pivot because of panic over the equities market? Obviously. Like, if they pivot, if they go full Greenspan and just tank interest rates when things get rough, does the dollar go down? Yeah, of course it does. But what if the dollar goes down while the interest rate's going up? And that's the thing that concerns me. And I think given this bond auction discussion, that's what we're starting to see, the cracks, the chinks in the armor, so to speak.
Well, we just need to be watching the balance sheet. The Fed's balance sheet is key to all this.
That'll be an interesting chart to look at here at the end of this month when they put out the monthly balance sheet numbers.
Mm-hmm. Yeah.
Let us remember to do that after Thanksgiving.
Absolutely. And the fact that unemployment's up 0.5%, assets aren't moving, real estate markets are frozen, defaults and bankruptcies are up. Credit card debt just hit another all-time high over the 1.08 trillion, as far as U.S. household credit card debt. Holiday economic activity is shaping up really poorly, expected to just really flop. Yeah, to me, that's the primary underlying current. So what if gold and silver are down 3% right now? Again, it overshot on a geopolitical tension. It may do that again if tensions escalate. But you've got WeWork filing bankruptcy. That was a $47 billion valuation not long ago. And here's this company that's suddenly filing for bankruptcy. That's going to start ramping up. And so that's deflationary as you start to see the credit markets certainly tighten, but you also see money disappear as a result of that. So anyway, a lot of fundamentals, too many to keep track of. And I appreciate you asking the question, Rob, even if you may regret it now.
Yeah, we said we'd start the show with that question, not also finish it. So there you go. And on an optimistic note, I think just for fun, with gold coming down, I know we come in here every week and we talk about the daily and weekly movements of gold going up and down. I think despite talking about lack of interest or focus elsewhere or holidays coming in or everybody's talking about the bond market or all the geopolitical things taking place right now, the only person that's asked me why gold's going down are you two. And I really appreciate that. It really means a lot to me when I know that the types of people that listen to our show, that listen to David and Kevin every week, that work with us as a company, we can talk about market movements up and down all day long, but ultimately I appreciate that All three of us here in this room and all of the clients we work with, we know why we own gold. I don't care what the US dollar does. I do not care what the stock market does. I don't care what interest rates do. I don't care what the price of gold is. It will always be a significant portion of my overall portfolio because I know what the alternatives are.
Right. Well, I think that's it for this week. Thank you for listening to Golden Rule Radio. If you have any questions, Miles can tell you where to go.
Okay. One of these days, somebody else is going to memorize our outro. So here we go. You ready? Take some notes, Rob. Thank you for listening this week to Golden Rule Radio. If you liked what you heard, hit the subscribe button and ring the bell. You can find more info on our website at McIlvaney.com. We're also on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you'd like to discuss your personal portfolio with one of the advisors here at McIlvaney Precious Metals, give us a call at 800-525-9556.
Thanks for listening. Have a great week.